An IPO is a sale. The seller sets the price, picks the date, and writes the document you are supposed to read. None of that makes it a bad deal. It makes it a document you have to read properly. 6 things to check before you apply. Check 1. Where the money actually goes. Every IPO is a mix of 2 things: a fresh issue and an offer for sale. Fresh issue money goes into the company. New shares, new capital, something gets funded. Offer for sale money goes to the selling shareholder. The company receives nothing. Neither is wrong. But an issue that is almost entirely offer for sale is an exit, not a fundraise. The split is on the cover page of the red herring prospectus. Check 2. The objects of the issue. This is where the company says what the fresh money is for, and SEBI limits how vague it is allowed to be. General corporate purposes are capped at 25% of proceeds on the main board. For SME issues, 15% or 10 crore rupees, whichever is lower. If the company has not named its acquisition targets, that bucket is capped at 25%. Together with general corporate purposes, 35. The closer an issue sits to those ceilings, the less you actually know about where your money is going. Check 3. The restated financials. 3 years, restated and audited, sitting in the prospectus. Look for revenue that grows while operating cash flow does not. Read the related party transactions. Read the contingent liabilities. And read the auditor's qualifications and the CARO reporting, not just the profit line. Check 4. How the price was set. There is a section called basis for issue price. It is the company's own justification for the number. It carries the price to earnings multiple, the key performance indicators management has chosen to show you, and a comparison against listed peers that management has selected. So read the peer set critically. And gray market premium is not a valuation. It is an unregulated, unofficial quote. Tells you about sentiment. Tells you nothing about the business. Check 5. Who can sell and when. Half the anchor investor allocation is locked in for 90 days from allotment. The other half, for 30. That 30th day is a real supply event. Put it in your calendar before you apply, not after. Check 6. The risk factors. Everybody skips them. They are the most honest section in the document, because the company is legally obliged to disclose what could go wrong. Revenue concentration, pending litigation, pledged promoter shares, negative operating cash flow, regulatory dependencies. If something worries you after reading those pages, that is the document doing its job. 6 checks. Where the money goes, what it is for, the restated numbers, how the price was set, who is locked in, and what the company itself says could go wrong. None of this tells you whether to apply. It tells you what you would be applying to. This is education, not investment advice. Read the red herring prospectus and speak to a registered advisor before you invest.